$2.1 trillion. That is the estimated amount of capital BlackRock has reallocated away from U.S.-centric exposure across its global portfolios over a compressed period of time. Not liquidated overnight, not dumped into the market, not announced at a press conference. Reallocated, quietly, gradually, across mandates most people never read. And if that number sounds abstract, let's put it into perspective. $2.1 trillion is larger than the GDP of most developed nations. It's more than the combined market value of many entire stock exchanges. And it represents decisions made not by retail investors, but by the largest asset manager on earth. BlackRock manages more money than any institution in financial history, more than most central banks, more than the combined sovereign wealth funds of several continents. Which means when BlackRock changes positioning at scale, it isn't speculation. It's signal. Now, before we go any further, something needs to be clear. This was not a single trade. It was not a headline-grabbing exit. And it was not framed publicly as leaving America. That's not how institutions operate. Instead, the shift appeared the way all major capital movements appear in their earliest stages. In allocation changes, in regional weighting adjustments, in mandate language, in risk disclosures, in where new inflows were directed, and where they were not. Most people never notice these changes. Because they're buried in quarterly reports, portfolio rebalancing notes, and long-term outlook documents written for institutions, not the public. But when you step back and connect the dots, the direction becomes unmistakable. Capital was not fleeing in panic. It was rotating with intention. And that distinction matters. Because panic is reactive, rotation is preparatory. While public conversation remained fixated on elections, headlines, and short-term market swings, the largest financial institution in the world was quietly adjusting for a very different set of risks. Systemic ones. This video is not about fear. It's about interpretation. By the end of this series, you'll understand what BlackRock actually did, why they did it, what conditions force institutions to move before the public, and what historically tends to follow when capital behaves this way. Not opinions, not predictions, patterns. Because this exact behavior, quiet, massive, methodical reallocation by dominant financial institutions, has appeared before. And every time it has, it marked the same moment in the same cycle. The moment when confidence remains publicly intact, but privately begins to fracture. Now let's address the obvious question. Why hasn't this been front-page news? Because large institutions don't announce exits from systems they're still operating inside. They don't use the word risk when rebalancing will do. They don't say, we're concerned about the future of U.S. assets. They say, diversifying geographically, increasing resilience, positioning for long-term structural shifts, adjusting for macro headwinds. The language is calm. The implications are not. Over the last several reporting cycles, BlackRock has steadily reduced net overweight exposure to U.S. equities relative to global benchmarks, increased allocations to non-U.S. infrastructure, expanded exposure to commodities, energy transition assets, and hard asset-linked investments, elevated emphasis on emerging markets, particularly those tied to resource production and manufacturing, increased strategic language around currency risk, fragmentation, and geopolitical realignment. None of this screams exit. But together, it tells a very specific story. And it's a story that only makes sense when you zoom out beyond quarterly returns and look at the system as a whole. Because institutions like BlackRock do not move based on ideology. They move based on constraints. They don't ask, what do we believe? They ask, what breaks first? To understand why this matters, you need to understand how institutions see the world differently than individuals. Retail investors think in terms of markets going up or down, bull versus bear cycles, elections, interest rate cuts, news events. Institutions think in terms of liquidity, counterparty risk, currency stability, debt sustainability, political constraints, systemic feedback loops. They are not trying to beat the market. They are trying to survive transitions. And transitions are where the real damage and opportunity lives. What BlackRock's reallocation signals is not a short-term call on American markets. It's a response to structural pressure. Pressure that builds quietly and then resolves suddenly. To see why, we need to step back, far back. Because what's happening now isn't new. It's part of a repeating sequence that has played out across centuries, empires, and reserve currencies. Different countries, different technologies, different political systems. Same pattern. And in every case, the earliest signal was not collapse. It was capital movement. Silent, orderly, rational. That's where we are now. Before markets react, before headlines change tone, before the public conversation catches up. So in the next part, we're going to do something essential. We're going to step away from the present entirely and look at the historical cycle that governs what happens when debt outpaces productivity, capital becomes trapped inside a dominant system, and the institutions with the most to lose begin preparing, quietly, for what comes next. Because once you understand that cycle, BlackRock's behavior stops being mysterious. It becomes logical. And once something becomes logical, it stops being ignorable. When institutions like BlackRock move capital, they do not behave the way individuals expect. They don't sell the top. They don't react to headlines. They don't wait for confirmation in the news. And they certainly don't explain themselves in plain language. Instead, they operate using a playbook that has remained largely unchanged for over a century. One designed not to maximize upside in good times, but to minimize irreversible loss during transitions. To understand why BlackRock's $2.1 trillion reallocation matters, you first need to understand how institutional capital actually moves. Because what looks like an action to the public is often deliberate preparation behind the scenes. Retail investors imagine exits as dramatic events. Markets crash. Prices gap down. Panic spreads. Institutions do not wait for that moment. By the time panic appears, it's already too late for size. When you manage trillions of dollars, speed is not an advantage. Liquidity is. And liquidity disappears precisely when everyone tries to move at once. So large institutions behave differently. They move early. They move quietly. And they move in ways that look boring until they're finished. Instead of selling America, they stop increasing exposure, allow positions to mature without renewal, redirect new inflows elsewhere, adjust benchmarks, reclassify risk assumptions. Change the language used in mandates. This is not speculation. It's how pensions, sovereign funds, insurers, and endowments have always repositioned ahead of systemic shifts. Capital doesn't flee. It rotates. And rotation is almost invisible unless you know exactly where to look. Historically, institutional capital reallocation unfolds in three overlapping phases. Not days, not weeks, years. Phase 1. Exposure neutralization. This is the phase we are currently in. Institutions stop increasing exposure to the dominant system. They don't exit outright. They simply reduce overweight positions, let passive exposure shrink relative to global growth, avoid long-duration commitments tied to one currency or political system from the outside. Nothing looks wrong. Markets may even rise. But internally, risk models are being rewritten. Language shifts from growth opportunity to risk-adjusted resilience. That shift is subtle, but it's decisive. Phase 2. Capital redirection. This is where the money actually goes. Not into cash, not into panic hedges, into assets that function across currency regimes, hold value during monetary instability, benefit from fragmentation rather than globalization historically. These include infrastructure, energy, commodities, real assets, select emerging markets, strategic metals. Shorter duration instruments. These allocations are rarely framed as defensive. They are described as structural opportunities. But structurally, they serve one purpose: optionality. Phase 3. Liquidity preservation. This phase arrives late, usually after volatility begins increasing. Here, institutions reduce leverage, increase balance sheet flexibility, shorten maturities, raise internal liquidity thresholds. This is the phase the public associates with risk off. But by then, most of the repositioning has already happened. The damage is done to those who waited for confirmation. BlackRock does not just manage money. It advises the system. Its models are used by central banks, governments, pension funds, insurance companies, sovereign wealth funds. Its risk framework, Aladdin, processes trillions of dollars of exposure daily, which means BlackRock sees pressure points before they show up in prices. Not because it predicts the future, but because it aggregates constraints: debt sustainability, interest rate sensitivity, currency exposure, political friction, liquidity depth. When those variables begin to align unfavorably, capital doesn't wait for validation. It adjusts. And the adjustments always begin with the same question: What assumptions are no longer safe? Over the past several years, one assumption has quietly shifted from stable to questionable. The assumption that U.S.-centric assets can indefinitely absorb global capital without consequence. That assumption powered decades of inflows. It also masked growing imbalances. Now, those imbalances are no longer theoretical. They are mathematical. For most of the post-war era, the United States benefited from a unique advantage. It could borrow in its own currency, run persistent deficits, expand its financial markets, absorb global savings, export inflation abroad. As long as global demand for dollars remained strong, the system held. But that system depends on one fragile input: confidence. Not political confidence, structural confidence. Confidence that U.S. debt will remain serviceable, dollar liquidity will remain stable, rules will remain predictable. Capital will not be trapped once institutions begin questioning that confidence. Even quietly, the logic flips. Instead of asking, "Where can we earn the most?" they begin asking, "Where can we exit if needed?" That shift is invisible in headlines, but it dominates internal decision-making. And it's the moment when capital begins preparing for fragmentation rather than integration. No institution wants to be first on record admitting systemic concern. Doing so creates the very instability they're trying to avoid. So the playbook demands silence. Reallocation without commentary. Preparation without warning. Risk management disguised as optimization. Historically, this has always frustrated the public. People ask, "Why didn't anyone tell us?" The answer is uncomfortable. They did, just not in words meant for mass audiences. They told us through asset flows, portfolio weightings, balance sheet duration, currency exposure, where capital stopped going. BlackRock's $2.1 trillion shift did not occur because of a single event. It occurred because the system entered a phase where the cost of staying concentrated exceeded the cost of moving early. That calculation has been made before, by Spanish bankers in the 1500s, by Dutch financiers in the 1700s, by British institutions in the early 20th century. Different eras, same logic. And the moment that logic dominates institutional behavior, the cycle is already turning. In the next part, we'll step further back, away from BlackRock, away from modern markets, and examine the historical cycle that governs what happens when dominant financial systems become overextended, and why institutional capital always moves first. Because once you see the cycle clearly, BlackRock's behavior stops looking bold. It looks necessary. Every dominant financial system in modern history has followed the same progression. Not approximately, not symbolically, structurally. Different centuries, different technologies, different political systems, but the same underlying mechanics. Because while empires change, capital behavior does not. What BlackRock is responding to is not a headline or a political moment. It's a phase change. And phase changes only make sense when viewed across long time horizons. To understand where we are now, you need to understand the full cycle. A cycle that has repeated with remarkable consistency for over 500 years. Historians use different names. Economists argue over nuance. But when you strip the narratives away, the structure is always the same. For stages, always in the same order, always driven by the same pressures. Stage 1. Ascension: a nation or system becomes the center of global capital. Its currency gains trust. Its legal system attracts investment. Its markets deepen. Its institutions stabilize. Capital floods in. Trade expands. Innovation accelerates. Debt is manageable. Productivity rises. This is the phase where optimism is justified, risk is rewarded, and confidence feels permanent. Historically, this stage lasts decades, sometimes generations. Because success reinforces itself. More capital brings more growth. More growth brings more trust. The system feels unbreakable. Stage 2. Overextension: success changes behavior. Governments spend more. Social promises expand. Military commitments grow. Debt accumulates faster than output. But markets don't signal danger. In fact, asset prices often rise faster than ever. Stocks hit records. Real estate booms. Credit expands. Central institutions learn they can smooth volatility. When problems emerge, liquidity is injected. And because it works, at first, confidence deepens. This is the most dangerous phase, because nothing appears wrong. Yet structurally, the system becomes fragile. Debt increases. Returns diminish. Complexity grows. and the system begins relying on continued confidence to function. This stage often lasts longer than people expect, which is why it's so often mistaken for stability. Stage 3. The silent transition. This is the phase most people never see. Because nothing breaks. There is no collapse, no crisis headline, no public panic. Instead, capital begins to behave differently. Institutions notice debt servicing costs rising, diminishing marginal returns, political constraints limiting flexibility, growing currency exposure risk, increasing reliance on intervention. The response is not exit. It's adjustment. Exposure is reduced quietly. Alternatives are explored. Duration shortens. Diversification increases. This phase is defined by silence. Public narratives remain optimistic, but institutional behavior shifts. Historically, this phase lasts 18 to 36 months. It ends not when everyone agrees there's a problem, but when something forces acknowledgement. Stage 4. Resolution. This is where the cycle becomes visible. Confidence breaks suddenly. Triggers vary. Debt crises, currency devaluation, banking failures, external shocks. Policy missteps, but the outcome is consistent. Asset correlations rise. Liquidity vanishes. Interventions lose effectiveness. Wealth doesn't disappear. It transfers. Those positioned early adapt. Those who assumed permanence absorb the loss. And after the resolution, a new system emerges. Different center, different currency, different rules. The cycle begins again. Most people believe risk is highest during collapse. It isn't. Risk is highest during misinterpretation. When people mistake stage 3 for stability. Because stage 3 looks comfortable. Markets still function. Institutions still operate. Headlines remain divided. But capital behavior has changed. That's the tell. And that's where we are now. BlackRock's reallocation did not occur during panic. It occurred during the silent transition. The stage where staying concentrated becomes riskier than diversifying, liquidity matters more than yield, optionality outweighs optimization. This is the phase institutions respect most. Because once stage 4 begins, size becomes a liability. Stage 3 is uncomfortable because it lacks drama. It doesn't reward urgency. It punishes complacency. People want clear signals. But systems don't provide them. They drift. And drift is only visible when you zoom out. Historically, the public always asks the same question after the fact. How did we not see this coming? The answer is simple. Because nothing looked wrong at the time. Until suddenly it did. BlackRock is not trying to predict stage 4. No institution can. Instead, it's responding to stage 3 conditions. Conditions like elevated debt relative to growth, increasing policy constraints, rising geopolitical fragmentation, currency risk no longer being theoretical. Intervention losing marginal effectiveness. When these variables align, the playbook activates. Not because collapse is imminent, but because the cost of waiting rises exponentially. This is the moment when institutions stop optimizing for upside and start optimizing for survival. Which brings us to the next critical piece. History. Because this cycle is not theoretical. It has played out repeatedly, with the same signals, the same behaviors, and the same outcomes. In the next part, we'll examine 3 historical case studies where dominant financial systems appeared stable, institutions began moving capital quietly, and the resolution arrived faster than anyone expected. Not to draw parallels, but to observe patterns. Because patterns don't care whether we believe in them. They repeat anyway. Before markets crash, before currencies fall, before history books assign blame, something quieter always happens. Capital moves. Not loudly, not emotionally, not all at once, but deliberately. To understand why BlackRock's behavior fits a familiar pattern, we need to look at moments when the world's dominant financial systems appeared stable, right up until they weren't. 3 cases matter most. Not because they were identical, but because the sequence was. In the early 1500s, Spain sat at the center of the global economy. Gold and silver flowed in from the Americas. Trade routes converged. The Spanish crown financed wars, infrastructure, and expansion. The Spanish real became the world's reserve currency. Confidence was absolute. But beneath the surface, the system was already changing. Spain's wealth was not productive. It was extractive. Gold inflows masked structural weakness. Spending expanded faster than taxation. Military commitments grew. Debt piled up. Interest rates climbed. By the mid-1500s, Spain was spending 3 times more than it collected. On paper, the empire looked unstoppable. In practice, bankers noticed the imbalance. Quietly, major financial families began shifting capital away from Madrid toward Genoa, toward Amsterdam, not because Spain had collapsed, but because servicing the system was becoming unsustainable. Then came the resolution. Spain defaulted in 1557, then again, and again, for defaults in 40 years. The currency lost trust. Inflation surged. The middle class absorbed the loss. Spain never regained financial dominance. The warning wasn't the default. The warning was the capital movement before it. In the 1600s, the Dutch Republic became the world's financial hub. Amsterdam's markets were the most advanced on earth. The guilder dominated trade. The Dutch East India Company became the most valuable corporation in history. Innovation flourished, but success bred leverage. Wars drained resources. Debt surged 20-fold. Asset bubbles formed. Behind the scenes, the Bank of Amsterdam, the most trusted institution in Europe, was quietly insolvent. Public confidence remained high, but insiders knew. Capital began moving out. Gradually, methodically, by the late 1700s, the system collapsed. Depositors were wiped out. The guilder lost reserve status. And global capital shifted to London. Again, the collapse wasn't sudden. The capital movement came first. Britain's dominance lasted longer than most. The pound sterling ruled global finance for over 2 centuries. Industrialization, empire, global trade. But 2 world wars changed everything. Debt exploded. Gold reserves vanished. The gold standard failed. Britain tried to maintain dominance. It couldn't. Quietly, corporations and wealthy families moved assets abroad. Not in protest. In preparation. In 1967, the pound was devalued overnight. In 1976, Britain required an IMF bailout. Reserve currency status was gone. The pound didn't disappear. It eroded, slowly, and British savers paid the price. Different centuries, different systems. Same sequence. 1. Dominance. 2. Overextension. 3. Silent capital movement. 4. Resolution in every case. The public remained confident, markets continued functioning, institutions adjusted quietly, and when the resolution came, it felt sudden. Not because it was unpredictable, but because it was ignored. These historical episodes reveal a crucial truth. Institutions don't move when collapse is obvious. They move when the margin for error disappears, when debt constrains policy, when currency risk rises, when intervention becomes mandatory rather than optional. At that point, staying concentrated is no longer neutral. It's a decision. BlackRock's behavior mirrors this logic, not because America is Spain or Britain, but because the system shows similar structural stress, and capital responds to stress the same way, regardless of era. In the next part, we'll bring the focus back to the present. Not emotionally, numerically. We'll examine U.S. debt, dollar exposure, interest rate sensitivity, and why the margin for error is narrowing rapidly, because history doesn't repeat out of nostalgia. It repeats out of constraint. Every financial system eventually runs into the same limiting factor. Not confidence, not innovation, not ambition, math. And right now, the United States is confronting a mathematical constraint that can no longer be managed quietly. To understand why institutions like BlackRock are adjusting exposure, you need to look past market narratives and examine the balance sheet. Because balance sheets don't respond to optimism, they respond to arithmetic. As of late 2025, U.S. federal debt exceeded $38 trillion. That number alone doesn't explain the problem. What matters is trajectory. In under a year, more than $2 trillion was added. Interest costs now exceed $1 trillion annually, more than the entire defense budget. And that's before refinancing risk. Between 2025 and 2027, over $9 trillion in U.S. government debt matures. That debt must be rolled over at interest rates multiple times higher than the previous decade. Every percentage point increase in rates adds hundreds of billions in long-term servicing costs. This is not a political issue. It's a structural one. For decades, the system relied on one assumption, that the U.S. could always refinance cheaply. That assumption was supported by dollar dominance, global savings demand, low inflation, central bank credibility, but those conditions are changing simultaneously. Inflation has reintroduced uncertainty. Rates are structurally higher. Global savings are fragmenting. Political constraints limit fiscal adjustment. This narrows options. When institutions evaluate sovereign risk, they don't ask, will this country default? They ask, what choices remain available? And the U.S. now faces a narrowing decision tree. Raise rates. Debt service explodes, growth slows, financial stability weakens, cut rates. Dollar weakens, inflation risk rises, capital confidence erodes. Print money. Purchasing power declines, trust degrades, long-term credibility suffers. There is no painless path. Only trade-offs. When financial systems transition, wealth does not vanish. It relocates. This is the part most people misunderstand. They imagine collapse as destruction. Historically, it's redistribution. And the distribution follows rules. Not moral ones. Structural ones. Capital is liquid. People are not. Jobs, wages, pensions, and savings are slow to adjust. Which means when systems shift, those tied to fixed structures absorb more shock than those tied to mobile capital. This isn't unfairness by design. It's physics. In every major monetary transition, the same groups feel pressure earliest and most intensely. Cash feels safe until purchasing power erodes. Fixed income feels predictable until inflation changes the math. When currencies weaken gradually, savers lose quietly. No headlines, no defaults, just less buying power every year. Historically, this is where the largest hidden transfer occurs. Wages adjust slowly. Prices adjust fast. During periods of monetary stress, real wages fall, living costs rise, household balance sheets tighten. This creates pressure not because people are irresponsible, but because systems are recalibrating. Pensions rely on assumptions. Stable returns, predictable inflation, long-duration confidence. When those assumptions weaken, funding gaps emerge. Those gaps don't announce themselves immediately. They surface years later, often when adjustments are least popular. Now the uncomfortable contrast. Groups that historically adapt better during transitions share common traits. Assets that produce value, not just price appreciation, adjust. Businesses, infrastructure, resource-linked enterprises. They reprice with the system. Exposure across currencies, regions, and legal systems reduces concentration risk. No single shock dominates. This is why institutions diversify geographically during transitions. Human capital matters. Adaptability matters more. Those who can shift roles, industries, or locations absorb less systemic shock. Because the system doesn't adjust symmetrically. Losses are diffuse. Gains are concentrated. And timing matters more than intention. Those who assume stability subsidize those who prepare for change. This has been true for centuries. BlackRock is not choosing winners and losers. It's responding to incentives. Its mandate is not fairness. It's fiduciary responsibility. And fiduciary responsibility demands early adaptation. That adaptation amplifies inequality during transitions, not because institutions cause the transition, but because they respond to it first. People often ask, what should I invest in? That's not the right first question. The right question is, what am I overexposed to? Transitions punish concentration, not participation. Understanding exposure matters more than predicting direction. Many assume this discussion is about fear. It isn't. It's about alignment. Aligning expectations with structural reality. Because systems don't reset overnight. They rebalance over years. And those years determine outcomes. In the final part, we'll zoom out one last time. Beyond BlackRock, beyond America, beyond the dollar, to the bigger picture. What this transition actually represents. And why it's not the end of money, but the end of an era. What you are witnessing is not collapse. It's succession. Financial systems do not die the way civilizations do. They transition. And transitions feel unsettling precisely because they unfold slowly until they don't. Every era of money rests on an assumption. For the past 80 years, that assumption has been simple. That one currency could sit at the center of the global system indefinitely. That assumption shaped trade, debt, asset pricing, political influence, capital flows. It worked until the costs accumulated. What BlackRock's $2.1 trillion reallocation signals is not rebellion. It's recognition. Recognition that the system is entering a phase where multipolarity replaces concentration. Not one reserve currency, but many settlement mechanisms. Not one financial center, but several. Not one rulebook, but overlapping ones. When the British pound faded, the world didn't stop trading. It adapted. When gold standards ended, money didn't disappear. It changed form. Each transition felt chaotic to those living through it. Each felt obvious in hindsight. No one knows the exact shape of the next system. But history provides boundaries. Expect greater currency diversification, more regional trade blocs, increased use of commodities and settlement, shorter financial cycles, higher volatility, lower tolerance for imbalances. This is not decline. It's rebalancing. The most important shifts happen before they are acknowledged. That's when positioning matters. Not because outcomes are certain, but because exposure is. BlackRock didn't move because it knows the future. It moved because it understands constraints. And constraints define behavior. People often ask, how did this happen? The answer is never hidden. It's just ignored. The data was public. The flows were visible. The incentives were clear. What changed was not the system. It was the assumptions people made about it. This is not the end of America, not the end of markets, not the end of wealth. It is the end of a period where concentration felt safe, and the beginning of a period where adaptability matters more than optimism. Capital has already adjusted. Institutions have already positioned. The public conversation always comes last. 5 centuries, 3 empires, 1 repeating cycle. The question is not whether the cycle exists. It's where you are in it. And now, you know.